Guys, welcome back to my YouTube channel. This is the Phipps Institute YouTube channel, and I want to wish everyone of my viewers a Merry Christmas in advance, and I wish you a prosperous New Year in advance also. Please, if you haven't subscribed to this YouTube channel, do well to subscribe and click on the notification bell so that you can enjoy educative and informative trading tips. So today, guys, I'll be talking on a vital subject in trading generally, which I believe it's not something that is strange, but it's not a topic that has not been thought before by other forex traders out there. But it's it cannot just be emphasized. Let me put it that way. I'll be talking about market structure in today's video. Market structure. So what do we mean by market structure? Actually, market structure just basically means the the way or the framework of the market of the forex or the of the of the market of the tradable assets. That's the framework, like the posture, the the way it appears. So that's what market structure really is. And market structure has can be simply be defined as we have three kind of market structure. We have the uptrend market structure, we have the downtrend market structure, and then we have the ranging market structure. Okay. So in this video, I'll be talking about just the two types. That is the uptrend market structure and the downtrend market structure. So I'm going to be speaking a lot about this. Now you hear a lot of traders saying that look, market structure is everything. That if you don't know market structure, then forget about it. Well, it depends on the angle you are looking at this from. Like I would not tell you what I don't know. Okay. And I'm not going to teach what I'm not very sure of, or I'm not going to teach what have not back tested and have not proven it to work. If others are saying that market structure is everything, that if you don't understand it, that you cannot trade, all this blah, 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 that is to them. But that does not, the fact that it works for them that way does not mean that it works for every other trader that way. So you must be ready and be prepared to be able to listen to other traders' side of the story, and don't just take one person's idea and then judge judge the whole market or everybody based on that and say because this person is not doing this way, he's not doing it right. No, the what really matters is that is the result, because it is the result that really tell if the person is doing it right or if the person is doing it wrong. Okay, so let us just go to the uptrend. Now look, the market is forming an high, then it comes back here. It's going to come to retest this level. Okay, and once it comes back here, it's what it goes back up, comes back here again, retest this level before pulling back up. It's as if the market it's as if there's there's something that the market is coming to grab there. It is called the market is coming to grab liquidity. Okay, the market is coming to grab liquidity. So the market is coming to grab liquidity over there. So you move again, then you come back here, move again, they come back here. So this is an higher high, and this is what the market is forming. That's what I'm saying. So this is the market structure. Okay, and if you should all this, though this is not what I'm talking about. All this, if you have to place your like your support line or your straight line, you can when you place it here, this all these places they can serve as key support level or resistance level, whichever one you want it. But that's not what I'm going to. So now, once the market comes here, You know what I'm saying? So you allow once the market makes this kind of move, it comes back here, then comes back here. At this point, the the bias has changed. Look, I need to explain something here. I'm not a forex trader or a forex coach that is going to bombard you with lots of terminologies that's going to blow up your head, because a lot of terminologies are being used in the forex market now that even someone without a good grades in English would hardly understand what the market is saying and what the trainer are saying. And then you're going to see a lot of terminologies that are being developed by this set of people. And I just want to know that these are man-made developed terminologies. So you don't have to make use of the terminologies. You can just form your own that you will make sure that it's so simplified and very, very understandable by everybody. And it'll be so easy for everyone to understand. So at this point, now the the direction or the structure of the market has changed to what? To a bearish market. Why do we say that the direction of this thing have changed to a bearish market? Once the market breaks this last push. This is a this place. In here, there is a liquidity. There's liquidity here. There's liquidity here. That is why you see that there's liquidity here. There's liquidity here. There's liquidity here. I'm showing it L. So all these places, there are places where there are liquidity. And the fact is that the market cannot move without enough liquidity, because the market needs to move up, needs to go up. So what the market has to do is that it has to come down here to grab some liquidity before moving up. And there are zones that you can expect lots of liquidities, like at the low of yesterday, the highs of yesterday, the lows of last week, the highs of last week, the lows of last month, the highs of last month, the lows of last year's, and the highs of last year. So all these zones are all these areas are where that there are a lot of liquidities that that's the reason when you study my M and W pattern, I mean, yes, market maker pattern, you will see that I make an exception to a kind of M to W. I call them an intraday M, that is an M that forms between 2 days. And I told you that that kind of M formation, it's always very effective and very, very valid. They are high setup and high probability. Why are they so? It is because at the high of yesterday or at the low of yesterday, there are a lot of liquidity in that place that is going to push. If the markets are the low, it's going to push the market up, because it's going to the market makers have a lot of liquidity that are there that is going to make it that's going to make the market to go up. And if they are the high of yesterday, there is a lot of liquidity that is at the high of yesterday that's going to push the liquidity down on the market down. Okay. So that being said, so these are liquidity. So once the market breaks this last push, there's a candle, there's a bullish candle, I mean a bearish candle that was responsible for the high of this place. So once bearish candle is broken at this point, so we can confidently say that the bias or the structure of the market has changed from the original bullish bias now to a bearish bias. Now, if you want to take this kind of trade, what do? You wait for the market to come back and retest this level. So once the market come back, retest this level, then it keeps on going down. This the way it comes. I hope this has solved a lot of things for you. Now, this kind of concepts, myself and John Hudson, that is the man who founded SMC, we agree on this kind of thing together. Now, when I say we agree, I know you might say, okay, what this guy is saying, does it mean that it's better off than no? Well, there's nothing like, there's no way that you can evaluate the best trader. Okay, but what I'm saying is that the concept, that the thought about market structure, I really, it's what myself personally, I see that it really works. Okay, it's what I myself have developed in a while, and I agree with him on that concept that this is how market structure ought to look at how. So you would, and one thing I appreciate about this guy is that his strategy are so simple and so informative that you can easily get them, and without without stressing yourself too much. Okay, so this this is how you trade it. So for the this thing, for the for the downtrend, now for the uptrend, this, let's assume the market is coming down. I hope you now understand the concept of forming a lower low. Then once the market moves up, then breaks this low, then at this point we can say the market has changed from a bearish market to what? To a bullish market. So we are now in a bullish phase. So that's about that. So this is just one aspect of it. Okay. There's another aspect which I want you to pay attention to. This is just one aspect of it. But there's another aspect that I'm going to make the video on this. I don't want to make this video too long. Okay. So I'm going to make another video on market structure. Don't forget this. This is just the change of character here is a what? Is a V. You can see it over here. A V. Okay. A V. So the change of character here is just normally a V. Okay. But there are some aspects of this thing that you still need to understand, that when the market is about to change of character, there's some pattern that it's going to give you. Apart from you seeing this place being broken, okay. Apart from you being seeing the last push to the upside down, to the upside, to the upside, or the last push to the downside being broken before you know that, okay, this is about to change. Or this has already changed. Okay. But ideally, this is what we call the change of character. Once the last market, the last level that pushes the market upside down breaks, then we see that we can confidently say that the market has changed structure. Like once it breaks this level, we can completely say that the market has changed structure. So that being said, let us dive into the charts to look at examples of this. Okay, guys, here is the example of Euro USD on the 1 hour time frame. Over here, we can see an uptrend forming. Okay, you can see an uptrend forming. Then what happened? Can you see this? This is a V. Then what happened is you see the market moves down, breaking this. This is the candle responsible for the push up over here, breaking this level. And once it breaks the level, what the market did? The market keeps going down and then moves back up to retest this level that was broken. Now, at this point, we can confidently say, once it breaks this level, we can confidently say that the market structure has changed from what? From a bullish market to what? Now to a bearish market. Now you can see that once the market breaks, let this level, then it's what? It keeps on going down, going down, and going down. You understand? So this is what we call market structure. like if you want to know if the market is still on a uptrend, in as much as the last push that pushes the candle upward is yet to be broken, it shows that the market is still what is still in a bullish phase. And for you that understand the multiple time frame analysis, what you have to do is that you have to look for your uptrend in a higher time frame. Then probably the market is going up. Then what you are going to look out for is that you are looking out for what for a buy opportunity. And then when you go to a lower time frame, then you're looking for a buy opportunity. I'm just saying this in general, but nevertheless, this is not me how I trade it. Okay, I don't when I see a bullish uptrend, I don't look for a buy opportunity. I look for a sell opportunity, no matter the trend. You understand? I always counter trend every trend I see. I'm not looking for a buy when I see a bullish trend. I'm looking for a sell. And once my this thing, my setup, my criteria are met, then I I enter the trade in the opposite direction of the trend, not in line with the trend. But there are some people that teaches this concept like that when you go to the higher time frame and then you check for your trend for your market structure. That is the direction of the trend of the market. So once the market structure shows that it is going in a bullish trend, then you will go to the left time frame to look for a bullish opportunity to buy the market. But I don't do that. Okay, what I do is that I look for a sell rather in a bullish market. Like someone that like the market is giving you from here, it shows something like this and then something like this. No, if you're someone that just got in here, like you just open your chart and then you're around this level, what do you do? Will you do at this point? But you are looking for a what for a buy opportunity. Okay, for if I'm someone like you, I will look for a sell, and which the sell setup did not even play out in any of these places. So that's about that. So let's look for another. Um, let's look for sell a sell setup. All right, guys, this is still the Euro USD on the 1 hour time frame. I just want to make use of this Euro USD just basically so that we can just get this video done with. I don't want to make it to be too long. Okay, so as you can see, this is what we analyzed. So this is what we analyzed. We analyzed this like a buy, right? Gives us a buy, then moves up, gives us a buy, then excuse me, goes up, then gives us a buy, coming on higher high. What's happening? So just forming on higher high, on higher high, then gives us a V, then come back here. Are you getting what I'm saying? Then retest this level, meaning market has broken what structure. And after retesting this level, what does it give us? I told you once it breaks this structure, it's what the market starts moving down. And once it moves down like that, what you place a stop loss at around to take profit around here, and you enter here, your stop loss will be over here. I'm just saying that if you want to trade the market structure that way, and John Olsen, the owner of SMC, agree with me on this subject. Okay, so on this concept, so you can have anybody that says this concept is wrong, that the person does not fully understand market structure. This is the simplified way of trading market structure of understanding market structure. Don't let anybody teach you what is not it and then start making the whole thing complicated. All because I don't use big grammars like them does not mean that it is not working or I'm seeing rubbish. This is the simplified way. Stop letting people blow you up or cajole you with all their big terminologies in forex. Forex is simple for everybody that wants to learn it. It's very easy to trade. Okay, so then the market keeps on going. After it's tested that level, what does it do? The market moves down, then keeps on giving us the what? A lower low, a lower low, a lower low, then our stop loss was it, then come back here, and what did they do? The market broke this structure. It broke this structure that was responsible for the push up down. Another breaking this structure. Look at what happened. It didn't even look back. Then come back here. Now, at this point, I want to explain something. Look, the forex market is not you are not the one controlling the forex market. And please don't expect it to be all perfect. You know what I'm saying? Don't expect it to be all perfect. Now, in this place, you will see that the market indeed comes back to retest this level. And then it's going to give us a good entry to enter a sell, because the bias of the market as what? The structure of the market has changed from a what? From a bullish structure to what? To a bearish structure. At this point, we enter around this place. And then our stop loss is here and our take profit is here, right? But at this point, this is the structure that the market needs to break before we can consider the trend of the market as changing from what? From a bearish market to a bullish market. But look, it broke it, but it did come back to retest this level. Practically no. But look at where it came back. It's just retest a little bit and keep on going. So don't wait for the market to be perfect. There are two ways to this thing. Number one, if you're someone like me that I understand that it is the forex market is not perfect, you don't expect it, because once the charts begin to form, it cannot or might not be the same way it is in the drawing, but it's going to look like it. What you just need that you needed something that's going to look like it. So you can enter this at this place, or you let it go because it did not retest this level. Then you let it go. You must have a rule-based approach to entering your markets. So you can either have this kind of two approach that, okay, you are not expecting the perfect entry, the perfect structure to form. And while you can have another approach that you can say, I want the perfect structure to form, that I want it that it must retest this place. It must come back to retest this level that was broken. And if it does not, you are not looking at entering the market, which is good. The bottom line is that, are you profitable in this? And you must have a rule-based entry point that you use in entering the market, so that you don't just enter because you saw something, and then just enter. No, if you have a rule-based approach to entering the market, even if the market goes against you, you will be proud that, no, I entered this thing based on the rules, and probably the market maker saw something else that you were not seeing from your own end that made them to go the other way around. Not because your setup was not valid, or not because you didn't know how to trade, or not because you did not support the entry, but just because probably the market maker saw that there was still some liquidity to be grabbed down here. You can see that they might even come down here, all the way down here, to grab more liquidity before even moving up. That does not mean that you are not trading right, but it just means that the market maker changed their mind. Okay, so and then look at what we have, and the market keeps on going up. If you were me, your take profit will be here. And that is that about market structure. So the essence of this video is just to show you the market structure when you are to know, number one, when you are to know when the market is in a bullish trend, or when the bullish trend is over, and which I perfectly established that once this level, the last level that pushes this before the V formation, before the inverted V formation forms, then come back to retest, then it shows that this market that has been going up has changed structure from a what? From a bullish structure to a what? To a bearish structure. And the same thing goes for a bearish structure, that once the last candle that pushes the last level that pushes the candle downward, once it breaks structure, once the market moves up and breaks this level, then that means that the market has changed from a bearish structure to what? To a bullish structure. And that is what I've been able to establish here. And I've been able to add another tip of the iceberg to hit how you can even benefit by trading in like this structure, like this, the V way. And by the grace of God, next time I'll be talking about market structure. There will be a part two to this video. So I'll be talking about the other, there are two types that you still need to watch out for, apart from this V and the inverted V's. Okay. So that you still need to watch out for that's going to signal a change of trend in the market. Until I come your way next time, keep trading your forex market and then keep making money. And before I close, please, if you have not subscribed to this YouTube channel, kindly subscribe, like the video, and click on the notification bell so that you can get notified each time I upload new content to this YouTube channel. Stay blessed until I come away next time. Have a nice trading week. Bye bye.